Hello and welcome to this week's episode of the Stock Market Update brought to you by Conservative ETF Investor. My name is Ken and today's date is June 4th, 2017. Here we are on the home page, and once this video gets completed, I'll upload the video right here so you can click right on it in order to gain access to it. Scrolling down, we have our current recommendations, but let me go ahead and go to the current recommendations page, which is right here. And our current recommendations are our posture on all of our accounts, on all of the 7 ETFs that we follow are all on hold recommendations. You can see that right here. So it was a good week. Definitely a good week in the stock market. Everything is up. The portfolio is definitely up. Now, here is our portfolio. Oops. Here is our portfolio since our buy points. It's up a total of 15.89%. And here is our portfolio since 2017. Oops. It's up 8.59%. Let's see, going back to our homepage, on our portfolio, if you're new to the website, we have our portfolio ideas right here tab, and it tells you about the ETFs that we follow and the percentage recommendations for your portfolio in each one of the ETFs, so you can have diversification. And then you can read more about that in our portfolio ideas. Okay, let's move right on to the charts. Let me go back to the home page here on this one, and we're going to jump right into our charts, and we're going to start with the S&P 500. Let me take off inspect. And we like to use the weekly charts because the daily charts have a little bit too much noise in them for the volatility, and this kind of smooths it out when you look at it on a weekly chart. We use candlestick charts so that each one of these candlesticks is 1 week. You can see that we're in the weekly time frame right there. And we have a 5-year duration is this chart. So we're going back the previous 5 years. This is symbol SPY, okay, and this is the S&P 500. And we are in a rising wedge pattern, and you can see from the current week, which is that furthest bar over to the right, which is right there, you can see that we are just getting ready to touch or coming very close to the upper trend line in our rising wedge pattern. The S&P 500, or the spiders, went up 1.02% for the week, and that's what the price pattern did. Coming down here, we're going to look at our momentum indicators. And our momentum indicators, our top one is the MACD set at default settings. And so you can see over here in the thumbnail that we were bouncing around a little bit, but now we have broken above its signal line. You can see that numerically right over here, which is, let's see, 5.374. And this one is 5.327. So we're broken above the signal line. The only part that's worrisome here is the level of the MACD is up pretty high. These are pretty lofty levels. If you go back 5 years, you see this trend line right here. That's the highest point that we've been back in 2013 and 2014. And now we're above that line right now. So it's pretty lofty. Below that, we use the slow stochastics, again set at default settings, and we've come down and crossed above the signal line, which is all bullish, and we are above 80, all bullish. And that's it for the S&P 500. Let's move on to the next chart pattern, which is the cubes, otherwise known as the NASDAQ 100. This is technology, symbol is QQQ. Again, weekly chart, time, 5-year time horizon, is the duration that we look at. And the NASDAQ had a good week, up 1.59%. Now you see that in the NASDAQ 100, similar to the S&P 500, we were in a rising wedge pattern, but the NASDAQ 100 being stronger broke up above it and has stayed above it, and it's just going unbelievably up. Same thing here. You can see that we are going straight up on the MACD. Again, the problem that we're having is the level of the MACD is up so high, it feels like it's going to come down eventually. It's not going to stay in this pattern forever. This is going to turn and come around. You can see that the trajectory of it is, it's going up and it's breaking away from its signal line. It's just the signs of strength on it are amazingly strong. The slow stochastics, you can see that we're above 80 and it's tailoring off right there. Somewhat of a divergence compared to the price pattern, because you can see that the price pattern is just going straight up. And here on the slow stochastics, you're seeing it actually kind of taper off and taper down. That's that's a negative divergence actually, what that is. All right, so that is on QQQ. Let's go to our next stock chart, and that is going to be IWM. So we're going to look at the weekly on the IWM, and on that one there, we had a fantastic week. This is the Russell 2000, which is your small cap stocks, and we went up 1.68% for the week. Now here we have a rising trend channel. It's really not a rising wedge. They're almost parallel. And we've been in this since, I don't know, just in 2016. You can see on the most current week, we came down, hit that bottom rising trend channel, and intra-week went below it, but the market says, oh no, come right back up, and now we closed right here at this line right there. Let me move over to the thumbnail. You can see we closed right there, 139.85. That's the current price of the Russell 2000. And if this market were to continue to go up, this is absolutely going to come up and hit this upper trend line. Now, the Russell 2000 has been the weakest of the three markets, the NASDAQ and the S&P 500. The NASDAQ is above its trend channel. The S&P 500 is hitting its upper trend channel, and here the Russell 2000 is at the lower end of the trend channel, but finding support here. So that's how that's all diversifying out. Coming down to our momentum indicators, the Russell 2000 is below its signal line, but you can see it's clearly bottomed and is beginning to rise up and going to make an attempt to cross above that signal line. You can see in the slow stochastics the indecision that has happened here on the Russell 2000. We've come down here and then came back up, crossed back down negative again and bottomed, and now has broken above its signal line right there. That's bullish for the slow stochastics indicator for the Russell 2000. All right, let's move on to our next chart, which is going to be VEU. VEU is the Vanguard all world excluding United States. So here's your diversification. Symbol is VEU. Again, weekly chart, 5-year time horizon on the chart. Strong pattern. Nice week, up 1.35% for the week. We had a declining tops trend line. The VEU broke up above it, stayed above it, and has just gone on this straight trajectory up. Unbelievable strength that it is showing. The MACD is above its signal line, gaining distance between the indicator and its signal line, which is bullish. The problem with the MACD is the level that it's at for the last 5 years. It's right at the upper level there. So it's extremely strong. The slow stochastics indicator, you can see, came down, bounced off of the 80, came back up, and it's just staying there strong. So that is for the VEU. all world excluding United States. Next, TLT. TLT is 20-year Treasury bonds. Symbol is TLT. And this is our bond portion of our portfolio to give ourselves diversification. What a strong week bonds had, 1.95%, almost 2% for the week. And now, another interesting thing that happened with bonds. You see this trend line right here? We had a declining tops trend line, and we were wondering if indeed the TLT bonds was going to break up above it or if it was going to bounce down. Well, the strength of TLT was so strong that it has broken up above it, closed above it, and this has been the first time that it's done that, and this trend line started in mid 2016, so it's been intact for a while. The MACD has bottomed way back here at the beginning of 2017, been doing nothing but going straight up, and the slow stochastics here in the bottom bottomed over here at the same time horizon that the MACD bottomed, and although it's been a little bit of a bumpy ride, it is now crossed above 80. It's staying above 80. It's above its signal line and gaining distance from its signal line. All very bullish. It appears as if the next resistance for TLT is going to be way back here, which happened in 2015. It's about the 130 level. We're currently at 125.62. So that's bonds. Again, we have a hold posture. Just to recap, going back to our recommendations, on all of our ETFs, our current posture is a hold. Because with our trading indicators that we have here, we need to see the ETF actually begin to correct, soften up, come down, and break some support levels before we're going to put in our sell recommendations. And that's how that works with our recommendations. All right, let's move on to our next one. Our next one is VNQ, which is our real estate portion of our portfolio. Now, on our real estate portion of the portfolio, okay, so VNQ is the Vanguard Traded Real Estate Investment Trust. Its current dividend is 4.38%, which is not bad, but I've been doing research and I have found another real estate ETF that I am considering acquiring and replacing it because the dividend is better. You'll see here, let's see, the volume on the weekly chart is 17 million shares. Let me show you the other REIT that I'm in possibly thinking about. It's this one right here. And the volume is not quite as much, 421,000 shares for the week. But the, I'm sorry, it's not this one. That's the wrong one. It is not that one. It is this one. All right, there's 15 million for the week. Symbol AGNC right there. You can see that it's a financial mortgage REIT, but the dividend yield is 10.36% annually. I mean, that's a lot better than 4%. And the dividends are paid monthly, and it's been doing that since at the end of 2014. So that's really good. I'm pretty impressed with that, and I am strongly considering exiting out of VNQ and using AGNC for the real estate portion of the portfolio. So doing some research on this. I haven't made my decision on that yet, but I'm strongly considering it. And right now, you can see that on the momentum indicators, it started to come. Let me move this over so you can see the thumbnail. The MACD has bottomed and has come up. That's really bullish for this REIT. And the slow stochastics has bottomed and has crossed above its signal line. And this is a very bullish sign. I'm doing a little bit of cycle analysis, and the cycle analysis, we're in the upswing right now. So it bottomed right around the same time that this bottomed and has come up. And it hasn't closed above this high yet, but if it were to close above this high, that would be very bullish for this real estate investment trust, AGNC. So I'm going to keep an eye on this and see what we do there. All right, so that's going back to our portfolio. There's a VNQ. Now, we had a declining tops trend line. We broke above it and we closed above it. The next resistance point is going to be somewhere over here, 85.50, something like that, which is this tops trend line right there. It's a resistance line, so we'll see if we can break above that. Then the next one is going to be this one, just under $90 a share. And then if it breaks above that, it's blue skies above. The MACD indicator, you can see, has had some indecision, but right now has bottomed and is getting ready to cross above its signal line. If indeed this is going to go up and attempt to cross this resistance line here, you're going to see that MACD cross above its signal line. The slow stochastics has bottomed and has crossed above its signal line, bullish. And that's it for our VNQ REIT. Let's move on to the next one, which is gold. All right, so the symbol here that we follow is symbol GLD. It's the gold spider, traded on the New York Stock Exchange, currently trading at $121.61. We have had a declining tops trend line that has been in place for so many years. It's been more than 5 years that it's been in place. We have closed right on that declining tops trend line. Is the GLD ETF gonna finally get above it, close above it, and continue and reverse this negative momentum that has been plaguing GLD for so many years? Let's just see how many years it's been. All right, so right now I'm looking back 6 years. Let's go back 8 years. And let's do an update on that. Let's just see what 8 years looks like. Looks like that has gone on more than 8 years. Hold on. Let's go back 12 years. Update that. No, I guess that's it. Okay. It looks like right over here, just after 2011, is when, sometime in 2011, is when that top hit, and we have not crossed above it, and we've been in this declining tops. This trend line has been intact since. So good 6 years. All right, so let me get back to a 6-year time horizon and update that chart. Okay, so here we are, and here we are today. And move that over so you can see it in the thumbnail. So we're trying to see if we can get that up and above. Momentum indicators. MACD came down, did not cross its signal line, and changed direction and is now going up and gaining distance between itself, the indicator, and the signal line. Very bullish. We are somewhere around 0. We're actually at 0.765 on the MACD. Plenty of room for this thing to go way up. So it's plenty of opportunity to come up and go up. Slow stochastics bottomed, crossed its signal line, gaining distance between itself and the signal line. Very bullish. It looks like this is going to go, and it's going to break out and go up. Its next resistance line would be pretty decent resistance at the 130 level right there. And let's just throw on our inspect mode and just see where that is. So if we were to go up to the 129, 130 level, that would be gaining about 6% above where we're at right now. And then of course, if it can break up above that, it just keeps going up and up and up. All right, so that is our last ETF that we're going to look at today. Now we are going to look at our momentum indicators, our volatility indicators. This is the VIX, the volatility indicator. It tells you right here. And it is an indication to give you an idea of how much fear there is in the marketplace. When you have fear, the volatility indicator goes way up. And when the volatility indicator goes up, down here I got the S&P 500, symbol SPY, the S&P 500 goes down. So it's an inverse indicator. So as this goes up, the price of your stocks goes down. And this is the VIX, and it tracks for the S&P 500. It is very, very low. This is a daily chart. By the way, for the VIX, we use the dailies, not the weeklies. It's currently at 9.75. And and this is a time horizon that I'm using as a 1-year time horizon, okay? Now, you go back over last 1 year, we are at the lowest levels we have pretty much seen in the last 12 months, which should be bullish because the volatility indicator is so down. But when you're this far down and it doesn't appear as if it's going to drop anymore, it's going to eventually come up. And when that happens, that's going to introduce some really severe down days for the S&P 500 and for stocks in general. The MACD is below its signal line and gaining strength, going the opposite way away from its signal line, which should be very bullish for stocks. It just concerns me that we're at these very low levels. Okay, so that is for the VIX. Now we move on to the next volatility indicator, which is symbol VXN. This one is for the NASDAQ 100. So this tells you what's going on with the volatility for the NASDAQ 100. The NASDAQ 100 is, let's see here, what is the exact number? 12.91. And so it's not quite as low as the S&P 500 at 12-month lows, but it's pretty low. You can see that the 50-day moving average is clearly below the 200 and gaining momentum to go down even further. And for the MACD, it's right at 0, so it could go in any direction. Numerically, it's below its signal line, which is bullish for stocks. So we'll see what happens, but it's showing that it's clear skies ahead. Okay, right now what I want to do is I want to show you guys when we make our recommendations. This is part of our research to determine what's happening with the stock or the ETF. So as an example, with the S&P 500, what we do is we look at the S&P 500 and we look at what is the MACD. So we write down what our MACD reading is over here. Excuse me, the slow stochastics. This is the slow stochastics. My apologies. The bottom one is the MACD. And we look to see what that's doing, and then we look at the chart pattern itself to see what's going on. Is the 50 above the 200? Is it gaining? Is the slower moving average gaining momentum over that? And then we make a recommendation here. Then another thing that we do is we look to see what stage is the stock market currently in. We're definitely in a rising trend, and we have been for quite some time. Then we look at our seasonality cycles. Right now, we're in the bearish cycle because it's after May 1st. Between May 1st and October 31st is a bearish cycle for the stock market. So you can see here in 429 we were in the bullish cycle, and then when we went over to 5-6, which is after May 1st, we were in the bearish cycle, which we are currently in. Another thing we look at is we look at our presidential election year cycle. Our election year cycle, so right now this is the year after the election. And the year after the election, we usually have a gain in the market of about 5.04%. This is based off of QQQ. So if we go back here and look at QQQ, let's go to a weekly chart of QQQ, and we want to see where we are since 2016. Go to an inspect mode. So 2016 QQQ, 2017, right about there to here, That's about 18% gain for the year. So that's one way you could look at it. Another way you could look at it is over here, QQQ. Um, let's see, actually, go to my holdings. Let's do it this way. And QQQ has come up about 20% for 2017 in our portfolio. So this is 2017 portfolio gains alone, and QQQ has gone up 20%. Well, when we look at our seasonality cycles, normally the year after the election, QQQ goes up 5.04%, and we're quadruple over that. So we're, from that perspective, overvalued. Seasonality, we're in the bearish cycle. Um, Another thing that we look at is, we'll use QQQ as the example here. Another thing that we look at is we see what our recommendation is from the above information, looking at the MACD and the slow stochastics. We also do a seasonality analysis. What do I mean by that? Let me show you what I mean by that. So let's come over to here, and instead of doing a sharp chart, what we're going to do is we're going to do a seasonality chart for symbol QQQ. So we're going to hit that. Now, I like to go back and look at the last 10 years. You could go back on this one as far as 20 years, but for sake of argument, for my analysis, I go back 10 years. So we look at the current month, which we know is June. We have a 40% probability this month. You can see that here it was 70%, 40% of being a positive month, okay? Normally, the QQQ during the month of June, going back 10 years, has had a negative effect of 1.4%. It's going to go down 1.4% for the month. Now let's go back 20 years just for the sake of argument and see what that is. Going back 20 years, it's flat, and it's got 53% probability of being a positive month. It's almost half, so it's got a 50-50 chance of being positive or negative for the month. But I like to use recency bias involved, and so I like to only go back with the 10-year time horizon. So it does not look like it's going to be a positive month for QQQ. Now, if I go back and I look at QQQ, and I look at QQQ on a on a monthly basis, QQQ has already gone up 1.54% for the month. So when I look over here, and our current monthly return for QQQ is 1.54%, and for the last 10 years, it's got a 40% probability of being a positive month. That's less than half. And seasonality, it has been a negative month of 1.4%. We have a potential of going down from our current position of a positive 1.54% to a negative 1.4%. That's almost a 3% loss for the month from where we are now, based off of our seasonality analysis. Now, that could change our overall strategy with that information. But for conservative ETF investor, what we do is we are still going to give ourselves a hold recommendation on that analysis, because even though this is the numbers, but it tells me that the risk is increasing. But when we come over and we look at, let's go back, let's actually do a sharp chart QQQ. And then let me change over to my chart, which is on my weekly. We actually need to see the price pattern soften up and come down. So with the form of trading that we do, we actually need to see price pattern soften and come down before we're going to give that recommendation. So we are definitely going to be taking not getting it at the absolute highs. We don't get the ETF at the absolute highs, and we don't get it at the absolute lows. We try to get the meat in between. That's what we're after. All right, so, but I just want to show you that risk levels are definitely increasing, and that is the point that I'm trying to make. So based off of our analysis, we are seeing um, that the market has pretty much given us what it's going to give us based off of past results, talking about the election year cycle, and how much gain you're going to get. And normally it's 5%. We're up 20% for this year, the year after the election. Seasonality wise, we know that we're in the bearish time of the year. Um, Using seasonality cycles off of the QQQ as an example, normally we're going to go down 1.4% for the month. We're already up 1.54% for the month. So risk levels have definitely elevated. So it's important not to get too euphoric over what the stock market is doing, and realizing that we we're in an overbought situation, and the market will come down and it will correct itself. How it will do that is the part that nobody really knows. It could do that by moving sideways, and you can see that the MACD can come down naturally just by getting a sideways momentum. Or is the ETF just going to crash and burn and come down, and that's going to bring down your MACD level like that, and that's going to bring your price point down. So this is the unknown variable that nobody knows how things are going to transpire. But from a valuation standpoint, we're overvalued. It's clear that we are overvalued. There is risk levels are increasing in the market. And I just wanted to bring that up to your attention. So that's going to conclude this week's video. And you'll find us at Conservative ETF Investor. There'll be a link for it in the bottom of the YouTube video. Please hit the like and subscribe to my channel, and thank you for watching. This is Ken signing out.